Welcome to the Simply Safe Dividends channel. I'm your host, Ryan Bollinger. In this video, I'll analyze an out-of-favor stock that pays a monthly dividend, yields near 6%, and has paid safe dividends every year since the company was founded in 1969. I'm talking about Realty Income, which is one of the most popular retail REITs out there, and it has nearly doubled the S&P 500's total return since it went public nearly 30 years ago. But recent times have been a little bit harder for the company. Realty Income's current share price is not far from the levels it reached during the depths of the pandemic, and it's even below where it traded for a moment in 2013. But it's not just an issue of REITs being hurt by higher interest rates, even though that is an important factor. Realty Income has lost almost 20% since right before the pandemic started, while the real estate sector has been about flat. The stock has trailed the REIT sector this year as well. So a lot of investors are wondering what's going on with Realty Income. Is the dividend still safe and likely to grow, or could we be looking at a yield trap in the making? Before getting into why we think the dividend remains on solid ground, I want to talk a little bit about the importance of interest rates for the stock. I pulled some data going back to the year 2000 to plot Realty Income's dividend yield here in dark blue alongside the yield offered by 10-year treasuries in orange. If you're unfamiliar, treasury bonds are considered risk-free by most investors since they are backed by the full faith and credit of the U.S. government. Their yields play an important role in setting different borrowing costs like mortgages and valuing assets like stocks. In Realty Income's case, you can see that the REIT's dividend yield has strongly correlated with, or basically moved in the same direction with, the 10-year treasury yield. The only periods of notable divergences are the 2008 financial crisis and the 2020 pandemic, when investors flocked to the safety of government bonds, pushing their yields down, and sold off stocks, which sent Realty Income's dividend yield shooting higher. Since stocks are riskier than government bonds, Realty Income has always offered a higher yield than 10-year treasuries, with a typical spread of around 1.5% to 3% over time. With how quickly treasury yields rose after bottoming out at 0.5% in 2020, it's not a big surprise that Realty Income's share price came under some pressure to push its dividend yield up from below 4% to around 6% today. That's in line with Realty Income's dividend yield way back in 2007, which was the last time 10-year treasury yields were at their current level of about 4.3%. So from this perspective, there could be some hope that Realty Income shares are close to bottoming out if interest rates don't take another leg higher. If they do, you can see that Realty Income's shares yielded north of 10% in the early 2000s when the 10-year treasury yield went above 6%. This seems unlikely to happen again, but investors in the stock should keep this sensitivity in mind when you consider the shares and the real estate sector in general. Moving on from rate-driven valuation headwinds, I'll now use Simply Safe Dividends to show you why we think the REIT's dividend remains on solid ground. You can see we assign the company a Dividend Safety score of 80, which falls in our safe bucket and indicates there's a good chance Realty Income will be able to maintain its payout without problem, even in a downturn. We've been in the dividend safety game for nearly a decade and maintain a public real-time track record of every cut we've seen since 2015. The timeline here shows the dividend safety score we had given a company before its cut was announced. Over 97% of the 800 plus dividend cuts we've seen came from companies that failed to earn a safe or very safe rating from us. So why does Realty Income look deserving of a safe rating? Scrolling down the page, we can see that Realty Income has historically had a very strong commitment to its dividend, with 29 consecutive years of raises and safe payouts every year since the company's founding in 1969. The company's dividend has also grown at a low to mid-single-digit pace over time. But can that continue? A company's payout ratio can help answer that question because it shows us the percentage of a company's profits that are paid out as a dividend. When coverage gets too thin, that can sometimes spell trouble for the payout. When evaluating REITs, we want to look at a payout ratio based on a company's adjusted funds from operations, or AFFO. This metric is commonly used in the real estate sector to provide a more accurate representation of a REIT's cash flow compared to traditional measures like net income, since it adjusts for non-cash items like depreciation charges that are required to be taken on properties a REIT holds, even though real estate typically appreciates in value over time. Realty Income's AFFO payout ratio sat in the low 80% range for many years, but has actually strengthened in recent years to sit near 75% today. This is a very reasonable level for a stable business like this, which generates predictable rental income every year. Moving down the page, we can see that Realty Income's AFFO per share has slowly but surely increased each year over the past decade, even during the pandemic when many of its tenants had to temporarily close their stores. So that's a pretty impressive record of consistent growth. Realty Income's balance sheet down here supports the dividend as well. One confusing sounding metric you can look at here is the net debt to EBITDA leverage ratio. This essentially measures how much debt a company has relative to its earnings. To use a really simple example, a leverage ratio of 5 would mean a company had $5 of debt for every $1 of earnings. Realty Income's leverage ratio has remained pretty stable between 5 and 6 over the past decade, which is a level we think is quite reasonable for most REITs and helps Realty Income earn an A- credit rating from S&P. So there's no need to prioritize debt payments and deleveraging over dividends for Realty Income. Overall, we think it's business as usual for Realty Income's dividend. Investors can likely bank on a safe 6% yield with probably around 2% to 3% annual growth going forward. The final point I want to address are some investors' concerns that growth will be harder to come by for Realty. On one hand, it's true that the REIT sales have more than doubled since 2021, following a couple of large stock mergers with retail REIT peers like VEREIT and Spirit Realty Capital. Realty Income is now one of the biggest REITs out there, and it's hard to find needle-moving growth opportunities. The REIT has also said that it takes about $1 billion of investments now, mostly in the form of property acquisitions, to grow AFFO by just 0.5 percentage point. Finding enough opportunities to drive faster growth is certainly difficult, especially in today's environment where borrowing costs for Realty and other acquirers have jumped with the rise in interest rates, but sellers have been slower to reprice their properties at yields that make deals profitable enough for buyers who are using debt financing. This standoff could partially explain Realty's decision to expand beyond its core retail markets with moves into the casino industry in 2022 and data centers in 2023. While I'm generally not a fan of companies venturing into areas outside their wheelhouse, I don't worry about these modest expansions given Realty's track record and diversified cash flow stream. No industry exceeds around 10% of revenues, and its biggest tenant is just 3.4% of rent. The cyclical gaming industry is also only around 3% of sales too. But what about store closures? It's true that some of Realty's largest clients are shrinking their footprints. For example, Walgreens recently revealed that around 25% of its U.S. stores are unprofitable and will begin closing in the next few years. CVS and Family Dollar are also reducing their footprints, and Red Lobster filed for bankruptcy earlier this year. While these events grab headlines, they really aren't anything new for Realty Income's business. The reality is that some tenants are always shrinking while others are growing, including its biggest client, Dollar General. The REIT's tenant lineup would have actually looked even more concerning in 2019, knowing what we know today, when you had shrinking pharmacy chains like Walgreens, CVS, and Rite Aid, combined with struggling movie theaters AMC and Regal Cinemas, to account for 14% of rent, which is about twice as large as they are today. Those businesses have performed poorly over that time, but that still didn't stop Realty Income from continuing to grow its cash flow each year. This resiliency reflects Realty's focus on owning properties in high-demand locations, partnering with creditworthy tenants, and entering long-term leases often ranging from 10 to 20 years in length. Most of the REIT's leases are also known as triple net leases, which make the tenant responsible for paying all the operating expenses of the property, including property taxes, insurance, and maintenance costs. This helps reduce Realty's exposure to these costs and provides more predictable income. Overall, Realty Income looks like a safe income play with moderate growth potential. When you pair that with a defensive rental income stream and a dividend that gets paid every month of the year, the stock looks pretty interesting for retirement portfolios that want to avoid excitement. Investors just have to be comfortable with the REIT's sensitivity to interest rates, with most of the damage hopefully behind the company unless yields spike higher from here. Those are tough calls to make, which is why it's always really important to maintain a well-diversified portfolio that can help reduce most company and industry-specific concerns over time. Thanks for watching my talk on Realty Income. If you enjoyed this video, it would really help me out if you hit the like button below and considered subscribing to our channel, which will stay focused on analyzing different dividend stocks and funds, as well as providing grounded investing tips on this type of strategy. If you're looking for new tools that can help you keep your own dividend portfolio safe, you might also consider checking out our website, Simply Safe Dividends. We've helped thousands of everyday investors track their dividend income, avoid dividend cuts, and really just make better informed decisions with our suite of easy-to-use tools and research. It's completely free to try, and it only takes a minute to get signed up using the link in the description below. Thanks again for tuning in, and I hope to catch you next time.